Good afternoon, everybody, and welcome. It is my pleasure to be the moderator today for the Agricultural Excellence Your Farm Transition Speaker Series. My name is Samantha Jones, and on behalf of the McDougall Wealth Management Group, I would like to extend a very warm welcome to all of you. We sincerely appreciate you taking the time out of your busy schedules to join us over the next 2 days. So I'm a wealth advisor with NBF serving Alberta and the Prairie provinces. But I also grew up and still involved in my family's third generation commercial cattle and mixed grain farm in Balzac, Alberta. I am truly passionate about contributing to and advancing agriculture and the families which make up the backbone of the industry. Today, our goal is to provide you with important insight and tools to support the success of your farming operation, assist you in defining your transition goals, and keep your family relationships intact. I'm very pleased to welcome Bob Boser, partner and tax leader with RSM Canada, here today. So Bob specializes in tax planning for privately owned business. He grew up on a farm in Saskatchewan, and he still has a special interest in farm taxation and succession planning.
Okay, good afternoon, everybody. It's a little different speaking into a computer screen than to a room of faces, but I trust that there are people out there. Samantha, can we start the slide presentation? Okay, for today I had a few objectives. I just wanted to cover off a couple of the federal COVID programs to make sure people are aware of them, and there's some potential cash available for the assistance in your operations. I just wanted to very briefly talk about the structures that you can carry on a farming business within, and then in order to understand transition of either while you're alive or through a will of a farm operation, you have to understand the rules of the capital gains exemption and what we call the intergenerational rollover rules, or the tax-free transfer to a child. And then, time permitting, I'll just briefly cover off replacement property rules, which allows you to deal with, if you sell a property, how you can shelter the gain by buying another one. So in regard to the COVID programs, if you want to advance, Samantha, there are two main ones that I think apply to farmers. Now, the first one is, they have an acronym for everything. If you noticed in these government organizations, these relief programs. So the first one's called CEBA. It's the Canadian Emergency Business Account, and it's available to any business, incorporated or unincorporated. And there's a couple of criteria. So the first one is if you actually have payroll, pay wages, and last year in 2019, you paid more than $20,000 of wages, but less than $1.5 million of wages, then you qualify for this program. The second way that you qualify for this program is if you had what they call non-deferrable expenses. So these are expenses that you couldn't avoid paying. Consist of things like regular mortgage loan payments, rent, those kinds of things. So if those totaled up to more than $40,000 and less than $1.5 million, you also qualify for the program. So it is a $40,000 interest-free loan, but the interest-free feature is important. But the other feature is that 25% of this is forgivable if it is paid before December 31st of 2022. So if you borrowed $40,000 under this program, you repay $30,000 before the end of December 31st of 2022, then you've gotten this money for over 2 years interest-free, and $10,000 of it is forgiven and you get to retain. Now that is taxable when it's, the forgiven portion is taxable, but it is still extra money for your business. If the required payment is not made by that deadline of December 31st of 2022, then it converts to it becomes a regular loan that has to be repaid within 3 years, and it starts to bear an interest rate of 5%. So if you haven't already applied for this, but you think you're eligible for it, the application deadline is March 31st of next year, so it's rapidly approaching. This is not something you can walk into your bank and have them do. It all has to be done online through your online banking account. If you are applying under the payroll feature, you just have to get some information from your T4s from the prior year, and if you're doing it under the non-deferrable expense format, then you'd have to provide some information on those expected expenditures. Now, in October, they announced an enhancement to this program. So they announced an additional $20,000 loan, of which 40 or 50% will be forgivable. So all the terms are the same. Now, when I prepared this screen, at that point in time, there was no details or application available yet, but I read something this morning that it is now available. So if you had already received the $40,000 one, you could just go on and apply for this one in the same fashion as you did for the first one. If you haven't applied for it yet, you can, I believe, double them up and do it all at once. So, you know, of the total $60,000, you get an interest-free loan for over 2 years, and $20,000 of it will be forgiven and not required to be repaid. The second one, if you could advance, Samantha, is they use the CEWS, or CEWS is the acronym, and it is the Canadian Emergency Wage Benefit Program. And so the way that this one works is you're eligible for it if you regularly pay wages. And it's a comparison of your current month revenue versus your prior month revenue, either of the prior year, or there's an option to look at January, February revenue of 2020. So each month you look at that, you make a determination if you qualify, and if you do, you can receive a rebate of up to 75% of the wages that you paid in the month. Now, the thing about farmers is there is typically income deferrals that go on under the cash-based system. And so a lot of farmers will defer their income till January of, last year they deferred to January of 2020. Well, that income becomes part of that January-February average. And in many cases, I've experienced a lot of farmers are seeing a large number for that January-February average. And when you compare it to, the revenue that was earned in March, April, May, June, etc., they're showing a decline, mainly because of this large deferral that took place at the beginning of the year. And these businesses are qualifying for the subsidy. So it's something to take a look at. I think you have to go the other way, Samantha. It went backwards. Be aware of the eligibility and apply for it if possible. Now, there are deadlines. This has been extended now until it started with March of 2020 and will go all the way to 2021 of March so far. The first 4 months are the key ones to look at if you haven't applied for it already. They are for March, April, May, and June of this past year, and they will. The application deadline for that is January 31st. So it's coming up, another less than 2 months. So if you haven't applied, talk to your accountant, talk to somebody, and see if you qualify and get your application in. We have quite a mess of a screen at the moment, so I don't have handouts. So I'm going to try and follow along. If not, I'll have to grab my other computer and boot it up.
Yeah, so I see that story there, Bob. I'm just trying to fix it on my end.
Okay.
So we'll see how we make out.
Bear with me. I'll be right back. So we're going to the backup plan. So I think that was it. What I had, everything that I had to talk about with the government subsidy programs to be aware of. The next thing I was going to talk about is the forms of structure. And so, as a farmer, there are really 3 forms of structure that you can operate under. One of them is acting as a proprietor. So that's just the individual farmer carrying on a business. The second is a partnership. And the third, which requires more than one person, you can have a partnership of 2, 3, or any number of people. And the last is a corporation. Now, each one of these has a different advantages and disadvantages. And there is no one right answer for anybody. There are just opportunities for each one. In general, the biggest concern with a proprietorship is a lot of times a farmer may sell a lot of their inventory, their grain, their cattle early in the year, and then they will look at ways in which they can, buy down that income by incurring expenses throughout the year to get down to a taxable level that they're comfortable with. if the proprietor dies partway through the year after they have all the income, but before they've had the opportunity to incur the expenses, they could be in a position where whatever is that net income up to that point is calculated as becomes the income that they have to report in their final tax return. So there can be an unusually large tax bill if someone dies unexpectedly early in the right cycle of the year, or the incorrect cycle, I guess you'd call it. A partnership avoids this because the partnership continues on as long as your partnership agreement says that the partnership continues if one of the partners dies. The last one is the corporation, and the main advantage of the corporation is what I'll call a tax deferral. You have a flat tax on your first $500,000 of income at 11%. So if your income rises suddenly in 1 year, you don't have to be as concerned about expenditures, or if you make a calculation error to get that income down, because at worst it's going to cost, the tax cost is going to be 11%. Nobody wants to pay more tax than they need to, but it does provide that lower tax rate. It is a deferral because once you eventually take the money out of the company, you will pay tax on it, and it'll all, in theory, balance out. But that is the main advantage of the corporation, is it allows you to have an initial lower tax rate. So the screens have some other general comments on it, but I think you can access those if you've got any questions on them, but they're just a general summary. So the more important thing I want to talk about today was the capital gains exemption and the intergenerational rollover rule. So there are some key concepts to understand in looking at these different rules. And one of them is that this applies to an individual. So the capital gains exemption and the tax-free rollover to a child or grandchild is only available to an individual. So if you have a corporation that you farm in and it owns land, it doesn't get a capital gains exemption when it sells the land. It cannot transfer assets to a child of the owner. It's only the individual, what they own, that they can transfer. They can transfer the shares of the corporation, but not what is within it. The second thing is we have to look at qualifying people or qualifying persons. And if you go to the next slide, Samantha, I've got a graph here that kind of shows what you would normally think of people who are related to you. So if you think of you and your spouse are in the center, everybody going above and below you, your parents, grandparents, children, grandchildren, you normally think of them as being related to you. On the same parallel as you would be, your brother, your sister, your brother and sister's spouses, your spouses, brothers and sisters, and their spouses. And then off of these lines is your aunts and uncles, they're parallel with your parents, your nieces and nephews, which are kind of parallel with your children. But for purposes of this qualifying person for these rules, we just deal with the ones that are in the black. So direct linear descent and ascent from you. So your parents, your grandparents, actually goes up to your great-grandparents, and then down child, grandchild, great-grandchildren. So for these purposes, your brother and your sister are not related to you. Your aunt and your uncle are not related to you. Your niece and your nephew are not related to you. So they are not qualifying persons. So if we could advance the next one. So we have an individual is the only one who can use this rollover and this exemption. There is some rules where this property, land, shares, etc., have to be used by a qualifying person. So you have to have a user, which is you, a qualifying person, or in certain circumstances, a partnership or a corporation that carries on a farming business. The next concept is activity. So there has to be some actual farming activity being carried on by one of these people. And then the last concept, or the next concept is the Tax Act uses the word principal use an awful lot. And principal use has been determined to mean more than 50% in relation to time and the actual physical use. So when you're looking at land, for instance, to be principally used, the area has to be more than 50% used. So if you got a parcel of land that there's a lot of bush or a lot of water on, where you can't farm that portion, if it makes up more than 50% of the area, you're offside. But if it makes up more than 50%, you're meeting the test. And then the other one is the time test, which looks at actively using it in more than 50% of the time. So the next concept to be aware of is, as long as these assets, this land or shares, are owned continuously in that direct lineage, which is that black line that I showed before, then you can always look back. So if you don't meet the use or the activity test, you can look up to your parent or your grandparent. So I've got a couple of examples. So if you consider a situation where dad owns land and he transfers it to his son, and his son then transfers it to his child. So now it's actually the grandchild who owns the land. That grandchild, whether they farm or not, if they don't farm, they're not meeting the activity or the use test. They can, however, look back in time to when their dad or their grandfather owned the property, and they can look at their use, and they can possibly meet the tests to be eligible for the exemption or the rollovers. Conversely, if you have a situation where dad transferred the land to his son, and then later on the son sold it to his brother. Now, brother is now the owner, but because this land wasn't owned continuously from dad to him, he can't look up to dad's activity. And so he can only use from the time he acquired the property forward to determine if he qualifies for the exemption and the rollovers. So there's a great advantage when land and other farm assets stay within that direct family chain. So capital gains exemption, everybody has $1 million of potential capital gains exemption. And if you have a gain on the right kind of property, then you can shelter that gain with the exemption. So the eligible property, the most common one is land. There can also be shares of a family farm corporation, interest in a family farm partnership, or quota. But the quota has to be owned by the individual or partnership. So, dairy, chicken, egg are the most common ones. But my experience is that for the most part, these are probably, because of the cost of them these days, is they're typically owned within a corporation, and so we don't see a lot of capital gains exemption used on a quota. So for land, there's a couple of concepts to be aware of, and the first one is it depends on when you acquired the land. So there was a change in the rules in June of 1987. So if you owned the land on June 17th, 1987 or earlier, you fall under what I call the old rules, and it's a lot more easy to meet this test to be eligible for the exemption. And it just says the land has to have been used principally in a farming business carried on by an eligible user in at least 5 years. Or in the year of sale, it's used principally in a farming business carried on by an eligible user. So what this means is principally, once again, 50% or more of the time, 50% or more of the area in at least 5 years. They don't have to be consecutive, they can be any 5 years. So if you advance to the next. So as an example, Dad acquired the land in 1960 and he farmed until 1985. So he farmed for 26 years. And in 1985, he transferred the land to his son. His son has not farmed it. He's just rented it to his brother and then later on to somebody else. So we learned that earlier that the brother is not a qualifying person for this, but dad is. So we have a situation where the land has went from dad to son, so it stayed in that linear relationship. Even though the son has never farmed it, he can look back at his dad's activity. So because this was acquired in 1985, which is before June of 1987, he can look back, and as long as dad used the land in a farming business in at least 5 years, then it's eligible for the capital gains exemption for the son, even though he's never farmed it. The next slide, please, Samantha. So then the second set of rules, I'll call the new rules, is for land that was acquired after June 17th of 1987. So the test here becomes more difficult to meet. So under this one, now there's a 24-month ownership test. So before I sell it, I have to have owned it for at least 24 months. Now, if I acquired that from one of the related person in that linear chain, then it's a combination of the two of us. So as an example, if I own farmland and I die and I give it, and my will says it goes to my daughter, and so 6 months later she sells it, her ownership period is her 6 months that she owned it plus my ownership period. So as long as that adds up to more than 24 months, you've met this first test. But the test here that is more onerous is we don't look at was it used in a farming business anymore. Now we have to meet a revenue test. So in at least 2 years, the gross revenue from the farming business has to be greater than income from other sources. So this, in our day and age when we have a lot of people earning off-farm income, is where the challenge can sometimes be to meet this test. So if you advance to the next screen, oh, sorry. The other test is if you actually farm, no, sorry, Mr. Matthew, go ahead. The second test is, you don't have to look at the revenue. If the farm land is farmed by a corporation or a partnership in which a qualifying person is actively involved. So rather than meeting the gross revenue test, if you have a partnership or a corporation and you have 24 months consecutive where it's farmed, it will now qualify for the capital gains exemption. So in terms of the gross revenue test, this is just an example of what someone's tax return looks like on the first page. And so they may have some employment income, some capital gains, and then from the farm, they had $100,000 of gross income, but only $2,000 net, so their total income is $57,000. Now the gross income test looks at what was the total income before expenditures on the farm, which is $100,000, and it is greater than the income from the other sources, which are only $55,000. So in this year, you've met the gross revenue test. You have two like that at any time, and now you've met that test, and the land would qualify for the exemption. However, if you get into a situation where on the right side, where the employment income was greater, it's now $100,000, it is the farm income is no longer greater than the other sources of income, and this would be a bad year that would not qualify. So you'd have to find 2 other years. So it's just a simple example of how the gross revenue test works. So another example then is if Dad acquired land in 1960, farms it until 1988 when he dies, and he transfers it to his son. The son is not a farmer, and he rents the land to his sister and then later on to an unrelated person. So this land was acquired by the son in 1988, so he falls under the new rules and has to meet that gross revenue test. So we know that he's not a farmer, so all he would have is rent income, would not meet that test, but he can look back to when his dad farmed it. And because his dad was a full-time farmer, you're probably pretty comfortable that Dad's gross revenue was all of his revenue, and so he would meet the test. He's grandfathered by his dad's activity, and this land, when he sells it, will qualify for the capital gains exemption to shelter the gain on the sale. And this is just a brief example of showing how if you use a corporation or a partnership, you can qualify it without worrying about that gross revenue test. So I have an example of Don buys 2 quarters of land in 2015, and he rents it to his son's farming corporation. And then in 2020, it gets sold. So the test here is in at least 2 years, was it used by a qualifying person in a farming corporation or a farming partnership? That test is met. So this land, even though that Don has never used it, never met the gross revenue test, he falls under that second test, and the land qualifies for the capital gains exemption for him. So those are some examples and the basic rules of the capital gains exemption. But the takeaways that I think are important are, number one, this only, with land, it only works on land owned personally. So if a corporation owns the land, there is no capital gains exemption for the corporation. Important to remember that cutoff date of June 18th of 1987, because you get into different rules, the old rules which are easier to meet versus the new rules which can be more difficult. Keeping land in the family chain is beneficial because it allows you to look back up your family tree for the activity of that previous generation, which may qualify you for the capital gains exemption even though you're not the farmer. Once it qualifies, it'll continue to qualify. So you meet those tests and now you're locked in no matter what you do in the future. And then I showed that, for someone who isn't carrying on a regular farming, or that isn't going to meet the gross revenue test, maybe because their off-farm income is too high, a way to look at qualifying the land for the exemption is by using a corporation or a partnership. Now, the rules get a little bit different for corporations and partnerships, and they're complicated. And I would say, really talk to somebody if you are in those situations and looking at, does your corporation or your partnership qualify for the capital gains exemption? But the basic rules are, there's a 24-month ownership period, just like there is in the land in the new rules. And then there's, once again, a principal use test, which looks at the assets of the partnership, and over any 24-month period, it says that you have to principally use them in your farming business. So once again, it's a time and use test. So more than half of the year, more than half of the area. Then there's a little bit more onerous test at the time of sale, which says, now we got to look at all the assets that are owned in the corporation, and 90% of them have to meet this principally used test. So as an example, if you consider a situation where somebody has carried on a farming business in a corporation or a partnership, and they have carried on that business for 20 years. And I'm going to need you to advance, Samantha, so I can remember what I've got written there. At the end of 20 years, so they farmed for 20 years, full-time farming. At the end of that 20-year period, they sold the equipment, and now they're just renting the land. So the land is still owned within the corporation, or it could be in a partnership. So at the end of this next 10 years, they want to look and sell the corporation, and they want to know if it qualifies for the capital gains exemption. So at that point in time is the land. If you'll have to go back one, Samantha. And so you look at the land, was it principally used in the farming business? So it was used for 20 years actively farmed, 10 not farmed. So 20 of the 30 years it was owned, it was actively farmed. 20 divided by 30 is 66%. So you met that 50% test. And even though this company hasn't been actively engaged in any kind of a farming business for the last 10 years, it will qualify for the capital gains exemption. Now, if we contrast that with the next example, which is basically the same, farm for 20 years, sell the equipment. However, we've built up some cash in the company. So we've got investments and GICs that are within the corporation, and they account for a total value of $500,000. Now, the land is worth $2 million. So we know that the land has met the principally used test, but the cash, the GICs and investments aren't used in the farming business. So now we're in a situation of, previously we only owned the land, which was 100% met that test. So we met that greater than 90% test. Here, at the time of sale, we have land that makes up 2 million of a total value of 2.5. It only is 80% of the overall assets. This corporation or this partnership would not qualify for the capital gains exemption. So the lesson out of this is, as your corporation or partnership matures and you're starting to build up cash and investments that aren't necessary for the business, you may want to look at ways to remove that from that corporation or that partnership so that it doesn't throw you offside from being eligible for the capital gains exemption. So one way, if you're in a corporate world where you're operating in a corporation, is there are some transactions that can be done to move that cash and investments over to another corporation, which will hold those investments. That can be done on a tax-free basis if it's done properly. And so what you've taken now is, before there was a company that it was worth $2.5 million based on the land and the investments, which did not qualify for the exemption, into a corporation that has $2 million worth of land that will qualify for the exemption, and the other investment corporation which doesn't. So you've taken a bad situation and made it much better. Next slide. So the takeaways here are just the main thing with shares of corporations and a partnership interest is to be mindful of the buildup of investments and other assets, and make sure that they don't get to be too large, and take steps if they are starting to grow as your business matures, and move those to another corporation or remove them personally for your own personal consumption. One thing to be aware of when you're using the capital gains exemption is there's something called alternative minimum tax. And for individuals who are over 65 and are starting to get the old age security, they can sometimes experience a clawback. So I'll try and briefly explain minimum tax. Your tax return, there is always a parallel calculation going on within it that you don't see. And it looks at certain things that are what they call tax preferred, such as special deductions, capital gains exemption, dividend credits. And so those are the main ones. And this calculation is always done, and it adjusts for these tax preferred things, and it recalculates your return. And if that results in a higher number, that is the tax that you have to pay. In most cases, in normal cases, this doesn't apply, but in times when you have a large capital gain that is sheltered by the exemption, the minimum tax can raise its head, and you may end up with a tax bill even though you don't expect that to occur. The other thing with the old age security clawback is that if you visualize your tax return, your capital gain comes into this part of the tax return, capital gains exemption comes down here. And in the middle, if your income exceeds $79,000 roughly, they start to claw back your old age security. And so when you've got the large capital gain that's offset by the capital gains exemption, they still net to zero, but they calculate the clawback in the middle. And so when you have this gain, you are likely going to be faced with a reduction or a clawback of your old age security. Just something to be aware of when you are having a sale where you use the exemption. Also of great interest and of great use is the tax-free rollover of farm property. So this allows you to transfer property with no tax consequence to a child. That rule is available to everybody for spouses. And so transferring to a spouse doesn't create any tax. If you are doing it while you're alive, there are some issues that can apply, what they call an attribution, where the income that the spouse earns on that property actually comes back to the transferor, unless you're doing some certain things to actually have it transfer at fair market value. That's less of a concern as dealing with the ones to transfer to a child. So the rollover to a child, if the property qualifies, allows you the best of both worlds. You can use your capital gains exemption to its best extent and then manage it so that you don't pay any tax. The child then acquires the property at this value that you've determined, usually your original cost, and they're only taxed in the future when they sell the property. So it is a way to defer the tax and move it forward. A couple of things to be aware of is that, for one, this is only available if your child is resident of Canada. So a number of people have children who have moved away and lives in different parts of the world. You cannot do this tax-free transfer to them. You can still transfer, but it has to go at fair market value and triggers tax. The other thing to be aware of is a 3-year rule within the Income Tax Act, which basically says that if you transfer property to a child at less than its true value, so you're trying to defer the tax, if it's sold within 3 years, or even if in that 3-year period a sale is arranged to happen at a later date, then what happens is that gain doesn't go to the child, it comes back to the transferor. So you get the worst of both worlds, in that the child gets the money and the parents get the tax. So as an example, and the reason for this is you think of a situation where mom has used all of her capital gains exemption, but she still owns a piece of land and it has a gain of $500,000. So if she sold that land, she has no exemption left, she'd have to pay tax on it, and she'd have tax of up to $120,000. Now, daughter has never used her capital gains exemption and really doesn't have any property that she'll ever use it on. So mom transfers the land to the daughter at her cost. So cost was $50,000 for the land, it transfers to the child at that cost. The child then turns around and sells it, realizes that gain, and then tries to use the capital gains exemption to shelter that gain. However, because if this happens within a 3-year period, the result is that that gain doesn't go to the child, so there's no gain to use the exemption on, and the gain actually goes back to mom, who has to pay tax. So a couple of rules or thoughts there are, one is just make sure you wait more than the 3-year period if you're doing this. This only applies if this is transferred while someone's alive. If this is transferred as a consequence of their death, the rule doesn't apply because you can't take the gain and put it back onto the tax return of a person who is no longer alive. So for land, in order for land to be eligible for the tax-free rollover to a child, we're back into that principal use test. So once again, it's a 50% of the area, 50% of the time. And this is the one, if you're in my office and we're talking and you're explaining when you bought the land and when you, how long you farmed it, I'll get out my fingers and I will do the calculating because I find that's a lot more effective. Be aware that crop sharing is not considered to be actively farming. And so once again, you can look back up at grandparents and parents' activity if that land has been transferred in an unbroken chain. So as an example, I think I have one here where parent owns the land and it has some water and bush, but of the 160 acres, 120 is farmed. So more than 50% of the area is farmed. So you've met that use test. Now we have to work at the time test. So Dad acquired the land and he farmed it from 1977 to 1999. So that works out to 23 years of farming. Then from 2000 on, the land has been rented to an unrelated person. So now we've got 21 years when it hasn't been farmed. So to check and meet the time test, we look and we see that it's been farmed for 23 out of 44 years, which is more than 50%. So this land would qualify for the tax-free rollover to the child. This will continue until next year, 2021, but then by 2022, if the arrangement stays the same, now you'll have 23 years of renting, 23 years of farming. So you no longer meet that 50% test. And so if this land was transferred to the child, it would have to go at fair market value, triggering a capital gain for the parent. Now, if it qualified for the exemption and they had exemption remaining, they could use that exemption. But if they didn't, it would create tax to the parent. So one thing to be aware of with property that is no longer actively farmed by a member of that family group is to be aware of these years. And at some point in time, the land will cease to qualify for the rollover, and you may want to transfer it before that termination date, even while you're still alive, to save tax down the road. So as an example, we have an individual who acquired farmland from his dad in $2,000, or in the year 2000 when his dad died, and he has cash rented it. Now he looks back to Dad. Dad bought it in 1955, farmed it till 1990, and then he cash rented it after that. So he eventually wants to gift it to his daughter. So the discussion we would have is, okay, from 1955 to 1990 is 55 years, is that right? If you go to the next slide, Samantha, it's 45 years, pardon me. He has actively farmed it, and then since then he has not actively farmed it. It's been cash rented. So we've got, 36 years of active farming, 30 of not. So we know that by 2025, Don has to do something. He either has to transfer it to his daughter to use this tax-free rollover rules or face the consequences of paying tax on it in the future. So that's just a general understanding of how that rollover of land works to a child. Now, you have the choice of picking where it qualifies, of choosing a value that is anywhere between cost and fair market value. And so you can manage the amount of gain that you want to pay, whether it's zero or the full amount of the gain. So as an example, if you had land that's worth $600,000 and had an original cost of $20,000, there's a built-up gain of $580,000 for. You've done the work, and you see that it qualifies for the rollover, and Dad has $100,000 of capital gains exemption remaining, and he wants to transfer it to his son. So what Dad would do is he would pick a number of $120,000 for the transfer value. That would trigger a $100,000 gain and he would use his capital gains exemption on it, and now the son has acquired it at a cost of $120,000. Now, if this is done through a will, that's all you do is you just report it on the tax return and all is good. If it is done while you're alive, then you have to actually create a transaction to make this a legal transaction with bona fide consideration. And so if dad doesn't want to get paid for this, normally what he will do is he would set up a, sell it for $120,000 and take back a promissory note from his son. And that note would just sit there forever and dad would forgive it in his will. That would allow the gain to actually be reported. Otherwise, the default is that it transfers at cost. And so dad doesn't use his exemption and the son acquires it for only a cost of $20,000. So you lose the ability to use that exemption out. So takeaways out of property being transferred to a child for land is be aware of the residence of the child. You want to use your capital gains exemption up on land that's going to go to a non-resident child and use the rollover for the land that's going to go to the resident child. Be aware of the 3-year rule. That only applies if you're doing this while you're alive, doesn't apply if it is through your will. If the farmer stops farming it and starts renting the land, then it's important to monitor that activity to find out when the that is no longer going to qualify. And be aware that the rollover gives you great flexibility to pick as much of the gain as you want to report. So the next slide is, oh, and then also be aware that these two things are not mutually exclusive. You can have a situation where the land qualifies for the exemption, but it doesn't qualify for the rollover, or vice versa. So you need to be cognizant of the two of them because the rules are a bit different for each of them. And that's an important factor in doing transitioning. So the next is just the rules for the corporation and the partnership, and they're very similar to the rule for the capital gains exemption. One difference is at the time of transfer, you have a 24-month ownership test, and then you're back into those 50% test over any 24-month period and the 90% test, which is identical to what I talked about on the capital gains exemption for shares or partnership interest. And here you're doing that same test. You look at the assets that you currently have. Are they good assets in terms of where they use more than 50% of the time? Are they offside of that? And do they make up more than 90% of the value? So same test that was talked about before. So this is just another example showing how cash can throw you offside. Just a reminder that just to watch the investment assets in the corporation, not only can they throw you offside for the exemption, they can throw you offside for the tax-free rollover to a child. So the main thing with shares of a partnership or partnership interest or shares of a corporation is just be aware of non-farming assets and don't let them build up. So just in terms of equipment, if you own the equipment personally, you can transfer it tax-free at its tax cost, which is depreciated amount. There is no similar rollover for inventory. So in many cases, say a farmer that operates as a proprietor and wants to transfer their farming business to a child can transfer the equipment tax-free, but they can't transfer the inventory. There's a tax cost to moving that inventory to the child. Less of an issue with grain, I would think, because you can stage your sales over a period of time and manage your tax. But when you've got a cattle herd, that's a little bit more difficult to transfer. So one way that you can to accomplish that is through a couple of steps. So one is you take your proprietorship and you set up a partnership, and there's a way that you can transfer your farming assets into that partnership without triggering any tax. So now you have a partnership which is made up of the child you eventually want to get the farm and the farmer. And the next step then is the farmer transfers that partnership interest to their child. And if we've met those tests, then that partnership interest goes to the child tax-free. Now you have a partnership that only has one partner, being the child. and there's a tax rule that says everything within it just winds up tax-free into the child who carries on as a proprietor as long as they continue the business. So that's an effective way to take a farming proprietorship and transfer it to a child on a tax-free basis by throwing a partnership temporarily in the middle. I believe I'm probably out of time. I got the signal a few minutes ago. So I think I'll go over very briefly on the replacement property rules, just so you understand the takeaway. If you sell land and have a capital gain on it, then if you buy more farming land that is going to be used in the farming business, and you do that either in the prior to the sale, the year of the sale, or the year after, you can basically shelter that capital gain as long as you spend all the proceeds. If you sell your land for $1 million and you only reinvest $500,000 of it and keep the other $500,000, there will be tax. But if you reinvest all the proceeds, then you can basically transfer the original cost of the old land. It becomes the cost of the new land, and you've avoided the gain. This is commonly done, where someone has a parcel of land that is further, or that maybe they can buy some land closer to home, and so they want to get rid of some land that is further away just to consolidate the farm operations. Or you get an offer you can't refuse for some of your land. You don't have the exemption anymore, and you want to go and buy more land. You don't have to. It doesn't have to be equal. You can. It isn't like I sell a quarter, I can only buy a quarter. There is no limit on how much you can sell. So, someone's fortunate to have land very close to a large urban center. They can sell it for a significant amount. Then they can go and buy more land to replace it and avoid the tax, build up their farm, their land base as a result. So I think I'll stop there.
Yeah, great. That's good, Bob. I'm going to put you live again here. So the guests can see you, and we got some Q&A in here, so I'll just throw those at you and hopefully you can give us an answer.
But I guess before I start answering questions, the takeaway out of this is understanding the building blocks. Then someone can put together, from a tax standpoint, an effective program to do whatever transitioning you want. Obviously you need to consider other factors. There's a lot of transitioning the farm to a child, and there are going to be people talking about the human factors to be considered in relation to that. This is strictly on the tax. I or anybody who is specialized in this area can put together an effective tax program for a transition, particularly with enough time and discussion. It's never too early to start these discussions to look at what the overall plan is. Plans change, but at least there's a plan in place. Perfect,
thanks, Bob. Yeah, I think making sure we focus, and I think Reg is going to touch on that this afternoon in his presentation, some of the soft conversations that need to be had versus the tax end is really more of a byproduct of it at the end of the day to bring it all together. So I have a few questions here I'd like to just go over. Is the CEBA available for personal or only company/corporation?
I believe it is available for anybody. It is available for unincorporated businesses as long as they meet those initial tests. So you have to either have the payroll, and many proprietors have a payroll where they're paying one or more employees, or the non-deferrable expense. I think there's also a requirement that you had to have a business account, although I think that they softened that because there was a lot of people who just used their own personal, kept their personal account for the farm, and initially they were disqualified. I believe that has been softened to a degree where I think the bank can transition into a business account. A lot of times people would avoid the business account because the fees were higher. So yeah, just use their own personal account, and that was throwing them offside, but I believe there has been some relaxation of that.
Okay, perfect. So hopefully that helps answer that question. When applying for the CEBA, I noticed that you have to have a separate business banking account. If you are a sole proprietor and your farm banking account is also your personal banking account, can you still apply for the loan? So sort of on that same topic.
Yeah, originally you were disqualified, but I think, and I haven't dealt with this myself personally at this stage, I believe there was some transition where if you talk with your bank, I believe there's a way you may end up with a business account in that name, but there was some concession made on that.
Okay.
I could look into that and verify it if.
Okay, yeah, if you have any more details on that, we can share that with the attendees after, if you have anything on that. Another one here, does using crop share versus rental income keep you qualified?
If you're talking about qualifying for the capital gains exemption, no, crop share is not considered to be sufficiently active. Now, crop share can be I'll call it a bit of a gray area because there are variations of it. The truest form of crop share is you're doing nothing. The person who's farming the land is doing everything, and you are just receiving a percentage of the crop. And then you go into variations of that, where the arrangement might be that you're paying for some of the inputs to the point of where the landowner is actually a little bit more involved in the operations where they're driving the tractor. It's not their tractor, but they're involved in the seeding. They're involved in the harvesting. Sometimes they're out driving the truck or the combine, just because of the nature of the relationship with the person who is farming it. There you're getting into a little bit more being able to argue that you as a qualified person, a qualified user, are actively involved in the business. But in its purest sense, it doesn't qualify. And if you are on any of these arrangements, anywhere where it's a little bit more gray, you want to document what you're doing and be comfortable that you are meeting enough of that activity test. So generally, I guess the answer would be crop sharing is no better than cash renting for purposes of the capital gains exemption or the rollover.
Okay, perfect. That sounds good. Just in the interest of time, I guess we are going to wrap you up here for the day and get ready for our next speaker. Thank you very much for joining us and participating today. If anybody has any questions, Bob and everybody at the RSM team is fantastic. They have a lot of great experience too, and we've worked with them quite a bit. So thanks Bob,